highly unusual situation going on here, given how much the market is corrected, anticipating slowdown in earnings and a recession and a Fed gone wild with another 75 and potentially another 75 after that. None of these rate hikes have affected the consumer yet, and I speculate it's for one singular reason. No economy has ever printed $6.72 trillion in 30 months. That's basically turning on the printing presses, printing money, giving it away for free, dreaming up other reasons to give more money away for free, such as student loan forgiveness, and then the Anti-Inflation Act. That's just hilarious to call it that. It's very inflationary. And so at some point, we'll have to stop printing money, but it hasn't happened yet. All-time record deficit, consumers flush with cash, and these earnings are proving it out this week. If we're going to get a slowdown in earnings, it's probably going to be in Q1 or 2 next year, because it doesn't look like it's going to make it this quarter. We've got a really perplexing, difficult time for investors. However, there's a new narrative going on in the market with investors regarding how the CPI is constructed. 40% is in shelter, and shelter stats are notoriously long dated. In other words, the numbers you're seeing now reflect the shelter market, the housing market, the apartment rental market 18 months ago, when it was smoking hot. That is not the case in major cities now. Rent increases have slowed down, housing prices have softened as mortgages have increased, and yet it's not reflected yet. So it's a little bit of saying, I want to change the data set now because I don't believe it anymore. That's kind of one narrative. But even though it's sitting at over 8%, the market is willing to fibrillate, waiting for more earnings validation that we actually have a slowdown. It's simply not there yet. And so if the Fed keeps using this 8% number and keeps ratcheting rates, they will overshoot. I have another index, Las Vegas, which I've never seen it fuller than it was last week at the Web3 conference. You couldn't walk in the aisles. It was so jam-packed. Casinos jam-packed, restaurants jam-packed, traffic jam-packed. So that pent-up demand is certainly there. Recessions start traditionally with a rise in unemployment. Haven't seen that yet either. If you're in the food services industries on either coast, where in California, for example, the minimum wage is $15, you can't even hire people for $23 an hour now. They don't even want to work. So that cash that's flushing around the system is still having an effect there. It's not clear how the poo-poo hits the fan on this one yet, but the market has made a decision. The corrections in the S&P 500 have been brutal and fast in every single sector. And so the market, generally speaking, is never wrong forever. And what it anticipates is a sharp decline in earnings, because right now the PE, if we believe the earnings for next year, is sitting between 14.5% and 15%. Well, that's getting close to a bottom. I mean, you could argue the bottom would be 12x, which is really, really low earnings for the S&P. But here we are at 15. I'd argue it's time to start nibbling. You can't guess the bottom, but my goodness, just on a strong index basis, you could go into this market saying to yourself, regardless what the correction is, 2/3 of it's baked in. And that is a good thing. The markets love gridlock. Markets like a pause that refreshes. We need a pause. The printing presses have gone insane, and that's why we have inflation in the first place. I mean, for all the talk about inflation, you print $6.72 trillion in 30 months. What the hell did you think was going to happen? Of course there's going to be inflation. I don't see anywhere you can be safe right now. You have to kind of tread water. I continue to add in 2 areas really high quality U.S. S&P 500 companies, of which I buy 100 of the 500 in an index from ALPS called OUSA. It's an ETF. Anybody can buy it. I'm not recommending it. I'm just saying what I use. And then I use another ALPS ETF called OUSM, and that is 200 names in the Russell 2000. So a fraction of the Russell 2000, the companies that make money. My whole thing now is, while I'm waiting in the weeds, is I'm willing to buy companies that are profitable, have high return on assets, and do cash distributions. Everything else I don't want to own, because those are getting absolutely crushed, and the bottom is not in yet. So many companies, when people thought, oh, it can't get any lower, and it goes down another 40-50%. Yeah. I think it remains strong at times of uncertainty and war, and we've got 2 wars going on, the Ukrainian war and the war with China, the economic war, and the threats as we build up more tariffs. We stop selling them chips for AI. At some point, these 2 sides have to come to the table because there's too much to lose. But there's a war going on there too. That brings a lot of instability. It certainly crushed the values of Chinese stocks, which are starting to look very interesting. These are companies in some cases growing still at 30% that are trading at almost single-digit PEs. Not yet, but getting close. And so when you get an Alibaba whacked, a huge amount, or a Tencent, or any of these names, I always wait for the blood in the streets to buy those things in the first place, and they're starting to look pretty interesting. There was a huge change in the direction of capital going into crypto in the last 6 months. So what's changed now is most of the investors that are willing to take the highly speculative investments, and some of them are large, a new deal called Misten, M-I-S-T-E-N, just got funded. Evan Chung was the name of the fellow who left Facebook. He was doing their digital currency. He took the whole team, set up a new company, raised $300 million in 45 minutes, basically without a deck. FTX was the lead investor at $100 million. I put money into that deal. He is promising a new blockchain to service financial transactions at 10 times the speed of anything else out there. And we do need that. So there's a lot of interest. But there's an example of a have company that really has no revenue. It's just starting its journey with now $300 million. It was almost 6x oversubscribed. The rest of the crypto market that came out of the DeFi space has been obliterated. And financings there are being done in crammed down rounds, 40, 50, 60, 70, 80% less than the last round. Very, very difficult. If the company's not profitable, there's not a lot of investor appetite for it. So you have the haves and the have-nots. In addition to that, the whole Web3 movement, which was what that whole conference was about, is more towards mass adoption. Everybody that's investing money into that is trying to solve for the wallet, number one. Number two, security. And number three, regulation. Those are the three horsemen of the new Web3 movement. Mass adoption through regulation, through security, and a much easier to use wallet. The best analogy I can give you, until your grandmother can figure out how to buy Bitcoin on her cell phone, we don't have a wallet that works yet. It has to pass the grandmother test. Well, I'm doing what a lot of other traders are doing. I'm going into the November time period with over 34 different positions on, many of them underwater. So naturally what I'm going to do now that the IRS and other regulators around the world are now looking at crypto in terms of tax compensation, very much like a security, I'm going to have to trade. So I'm going to be doing trading, taking some of the projects that have been decimated down 40, 50, 60, 70, 80, 90%, selling those and basically buying what I consider the granddaddy index of all crypto, Bitcoin. So I can go through the tax season owning more Bitcoin, I will, maybe a little bit more Ethereum, but basically the large market cap names are the ones that matter. So if you're going to do a basket of names to hold through the back end of the year, I would say it's going to be Bitcoin, Ethereum, Polygon, Solana. Those are huge market cap names, and I think are going to index together. I don't think any one of those breaks out of the pack. They all kind of trade in tandem. So if you're only going to own one, it's probably going to be Bitcoin, but all the rest trade in tandem with Bitcoin.